Where an early stage startup may have little or no historical performance on which to base value calculations, revenue, earnings, and other performance measures may become useful for a later stage company. As the company starts to generate sales revenues, valuation methods focused on earnings and revenue performance may start to become relevant. At this stage, the value is often determined by the company's revenue. If comparable private companies in the same sector have recently been acquired for, say, 3 times their annual revenue, it would be reasonable to value your company at 3 times the annual revenue. The financial projections of management may begin to hold some credibility. It may not be long before incoming cash exceeds the outflowing cash, so the discounted cash flow method may be a viable valuation technique. The value may also depend on the type of investor leading the round. New investors, anxious to acquire a stake in the company, will tend to offer higher valuations than existing shareholders. When it comes to a strategic round of funding, a corporate strategic investor will often agree to a higher valuation than a pure venture capital investor. Where venture investors are looking exclusively at the financial return, the corporate investor may consider other synergies and benefits to the parent company. For example, Intel has an interest in driving the adoption of Intel chips and often makes investments in startups developing technologies that will drive the growth in sales of semiconductors. By financing the startup, Intel may benefit from resulting chip sales, but the venture capital investor benefits only in the financial return on the startup shares. So a strategic investor like Intel may be able to justify a higher valuation than a venture capital investor. Where the VC usually negotiates with management and sets the valuation for early stage financings, a strategic or corporate investor may lead a later round of funding and may have more flexibility on price. In the mezzanine stage, the company now has a track record of financial results, and it may only be a matter of months away from IPO, so its shares can now be compared to those of known publicly traded competitors. By looking at the share price and valuations of existing public companies, the revenue multiple and earnings multiple techniques can prove useful to set valuations based on current public share prices in this particular sector. The company is still private and the stock is not yet tradable and liquid, so the liquidity discount should be applied when comparing with publicly traded stock. As there's a good deal more history to study, the valuation calculations can be much more reliable than they are in the early stages. However, the price very much depends on the current climate in Wall Street. This can be volatile and somewhat difficult to predict.